and I'm very honored and thrilled to moderate today's session on scaling early stage impact funds. I'm really thrilled to have our outstanding panelists from truly different regions in the world. So thank you, Susana, Hamdiya, Dondi, and Rodrigo for sharing your insights and perspectives. As we know, the world has been deeply shaken and disrupted in these last few months. And I think majority of us have been affected somehow. We have been challenged in our lives, in our assumption, beliefs, and also, I think, in our investment practices. We adjusted our plans, revised our plans, and made new plans. We, as OPES, an early stage impact fund working in different regions and also in Italy, have been experiencing a terrible delay in launching a new impact fund targeting impact early stage companies in Italy. And we had to postpone the first closing twice in the last 8 months. And we are finally now in the rush to finalize the first closing in the next coming months, and with an 8 months delay. But I would say that with the delay we have experienced as an early stage fund, we have also experienced a sort of good because we were able to unlock additional interest and binding commitments from investors that were initially out of our wishful list. So we will talk today about challenges, risk, potentialities in scaling up early stage impact fund. We will hear from all of you, and we wanted to make this section very live and very interactive with our participants. So I just remind you that this session is recorded, and I also ask participants to put their question in the Q&A box you see at the top of your screen. And I invite our panelists to be tight, punctual with time. We don't have much time, and we want really to leave at least some time at the end of the session for Q&A. So I will, before really entering in the conversation, I ask you to introduce yourself, starting with from Susana, and then Dondi, Rodrigo, and Hamdiya in this order. And you have each of you 1 minute to say who you are, what your organization does, and whether you have been engaged or you foresee to be engaged in any fundraising activity and scaling up activity for your fund, or any new financial resources deployment for you as a fund of fund. So Susana, I leave the stage to you, bringing your global perspective as a Capria, we know has been very global, especially in the market, emerging markets and frontier markets, and you also bring your experience, previous experience in the Latin American Caribbean region.
Thank you, Elena, and thank you to all the organizers. I'm Susana Garcia-Robles. After 20 years plus of being in the Inter-American Development Bank, building the venture capital / early stage impact industry, having invested in nearly 90 funds in Latin America and the Caribbean, I moved this March to Capria, which is a global fund of funds, and our target regions are LATAM, Africa, and Southeast Asia, and we work with our sister brand Unitus in India. And we really believe that ecosystems need to be built at the same time that we invest. And I'm also the executive advisor of the Latin American Private Capital Association, which is also joining forces and eventually integrating with the PIA, which is the Emerging Markets Association. So I have quite a bit of data that we'll be talking about in the next questions. Thank you.
Thank you. The stage is yours.
Hi everyone, my name is Dondi Hananto. I'm dialing in from Jakarta, Indonesia right now. I'm a partner with Patamar Capital. So we're an impact-focused venture capital investing in Asia and mostly in Southeast Asia. And to zoom in again, our four main markets are India, Indonesia, obviously I'm here, Philippines, and Vietnam. So we're doing early stage equity investments, Series A focused, with a ticket size of 1 to 3 million initial check size. Yeah, I guess that's one for the introduction.
Thank you, Dondi. Rodrigo.
Good morning. My name is Rodrigo Villar. I'm the founding partner of New Ventures, and I'm also the chair of the National Advisory Board for Mexico. So in New Ventures, we do a lot of things. We have some acceleration programs. We also have a private equity fund. It's called Adobe Capital. We are right now investing our second fund. We do early growth stage investments. We do equity, and we also do revenue-based lending, revenue-based financing. And we just recently launched another financial entity called Iguala, where we're doing revenue-based financing in a much smaller scale, and trying to get to a broader set of companies with a very innovative mechanism. Good morning, everybody.
Thank you. Hamdiya.
Thank you, Elena, and good morning from Accra to all participants, and thanks to GSG for putting this together. I work for an organization called the Venture Capital Trust Fund, and what we do is to support fund managers to anchor first managers to set up their funds. Mostly we've been working with first-time fund managers, investing across West Africa. And I am also currently the acting CEO for the Ghana Now.
Thank you. You've been fantastic, very punctual. So my first question, and I'd like to address it to all of you, because you really bring this expertise from a different regional setting. What have you seen in the last 10 years and the last few months in terms of relevant changes in the impact space for early stage impact funds? And have you seen any trends or any different dynamics in terms of scaling up, raising funds, or deploying funds to support the ecosystem? Susana.
Thank you, Elena. Well, 10 years ago, I think impact was still a mixed bag, many times perceived only as philanthropy. Today, we still struggle with some misperceptions, but markets and returns are showing that you can have what is called the triple P, profits and take care of the planet and people, especially because we are seeing little by little, much slower than we would like to, the inclusion of women as investors and entrepreneurs. And we know that women are 1.17 times more likely than men to create social ventures rather than only economic ventures, and 1.23 times more likely to pursue environmental ventures. Now, obviously, COVID was a shock to humanity, as you said, and the shock made us be paralyzed. But on the other hand, emerging markets are resilient. And from CAPIA, we have seen the resilience of all emerging markets we work in, they began to bounce back. It was first understanding the new reality, then accepting the reality, then accepting that there was a slowdown in investments. More than anything, I think the big losers, unfortunately, are those funds that were not already engaging in a fundraising process, but thinking they were going to start, and they hadn't personally got some contact. So after the initial shock, we saw that investors decided either to focus on relationships they had started, or to take care of the portfolio they already had, and if necessary, to re-up. But we definitely saw that just after 2 months into this COVID pandemic, people who had dry powder put into use. And I would say that there is another trend that I want to, and we'll talk for sure, which is COVID accelerated digitalization. That was in all emerging markets happening, but now is a must. We have in Capria, we have a way of talking about sectors, and we'll talk a little bit more later, about unexpected losers, sectors that should have performed well under a pandemic, and not so obvious winners. And I just want to give very shortly a description of 5 years ago, our partner in India made a bet on a company providing human resources management services for blue-collar workers, of which you have 170 million in India. Nobody else was interested at the time because they claimed that it was low revenue per worker, significant non-digital operational requirements, and 100% plus churn rates. The company had no other professional investors at the time. And now fast forward to COVID in August, and the revenues of this company have recovered from nearly hitting zero in April to being above pre-COVID numbers. They also have half dozen traditional venture capital and private equity investors knocking at their doors. And this is a scenario that we have seen played out during this crisis. Impact investors are the pioneers, putting capital at risk, but then if the entrepreneur was able to pivot and to show that resilience, the traditional investors are jumping in. So I would say the main trend I've seen during COVID is this digitalization and going back to the basics.
Thank you, Susana. I remind Dondi, Rodrigo, and Hamdiya, you have just 3 minutes each to pick up a trend that you have seen and the change that you have seen is affecting your region. Dondi, please.
Okay, yeah, I guess if I have to recall back to what the ecosystem looked like 10 years ago, back in 2010, I would say for us, we didn't have a fund yet. We were starting out. 10 years ago, we were trying to build a proof of concept, basically trying to prove to potential investors that there are actually deals to be done in this part of the world. Because I think back then, people didn't know what Southeast Asia looked like. Asia has always been very dominated in the discussions by China and India, obviously the larger markets. So Southeast Asia was very much not known in the international world. So yeah, so 10 years ago we were building that proof of concept. So if I liken it to an early stage company, we were building our MVP, the minimum viable product. And if we fast forward to now, 10 years later, we've got about 100 million in total assets under management. We've invested in 23 portfolio companies. currently. We're concurrently raising our third and fourth funds. One is an equity fund that we're targeting to get to about 80 million corpus. And then the other one is a debt fund. Is a debt gender lens fund, which is going to be mainly debt. So yeah, I think most important, I mean, those were the kind of our own evolution. But looking more broadly to the ecosystem, I would say definitely compared to 10 years ago, there are a lot more investors that are interested in impact. I think there's a lot of intrigue and a lot of interest about Southeast Asia because people hear about how the market has been growing and you know, good macroeconomic numbers in general. There's a lot of different investors with very different impact focus and industry focus. You know, so we are seeing an agriculture focused fund, an education focused fund. You know, we're seeing a lot more of that. And also people looking at different stages of the companies, right? So it's great that, you know, ecosystem wise, it has actually grown, but I still think it's not enough. You know, there's still so much to be done. You know, there are some niches that are still not covered, I would say. We still need a lot more in the even earlier stage, because, you know, people like us come in at Series A. There's a lot of companies that need seed investments of just 100 to 500K, and it's quite difficult to point them to different investors because we only knew so many. I can count them in one hand. You know, so you know, different financial instruments, I think is very much needed. You know, for example, Rodrigo is talking, he's doing some revenue-based financing. I would be very interested for someone to actually be, you know, doing that in Southeast Asia. So I bet I can learn a lot from Rodrigo here.
Thank you.
Yeah, so that's how it's evolved.
Thank you, Dondi. And what about your journey, Rodrigo, in the last few years and in the last few months, in terms of raising funds and raising? You mentioned that you raised a new facility, you launched a new financial facility.
Yeah, so we started our first fund about 10 years ago, and 10 years ago there was, I mean, not even impact investing. There was no investing in early stage, pretty much. So right now, I think the good thing is that there are many other funds across Latin America. I think it's growing a lot, early stage investing. And the good thing is that a lot of traditional private equity funds or venture capital funds are also looking for impact investments. So I think that has scaled a lot. I mean, I think there's still a lot of room to more funds that have the intentionality. I mean, it's good that other traditional funds are investing in impact, but I think we still need more funds that are intentionally investing in impact investing. And so we are investing our second fund. We do a slightly higher investments. We do probably average investment right now in our private equity funds about $3 million. Probably we're too far away from doing really early stage. So that's why we created our new facility called Miwala, which is this revenue-based financing. It's not equity. We cannot probably invest in the most innovative companies, but we can invest in a lot of them. So I think developing countries has a lot of great companies that are growing 20-30% per year, and probably are not attractive to venture capital because they don't have like a specific unique technology or a specific unique business model, but they're good companies. They can scale, and they need investment. So what we developed with this company Miwala is that we can invest ticket sizes right now about $70,000, and what we can do is that we can fix equity multiple, and then the companies pay a percentage of the revenues until they reach that equity multiple. So the good thing is with the COVID is that we did 10 investments before the COVID, and right now we have zero in terms of down payments. So all the companies are online with their payments. Of course, a lot of them are paying slightly less because their revenues fall, but they are all paying. So if we compare to traditional banks or traditional non-banking institutions, the performance is pretty well. And because we in our model we consider there are downhills in the life of the company. So the COVID was one of these cycles that it's down, but all the companies are paying because it's a flexible instrument. So we're very happy with that. We proved that these new financial mechanisms there's a lot of room. I mean, there's still a lot of room for innovation. I think just thinking about putting small equity tickets in a lot of companies, it doesn't make sense. We still see that there are no exits. It's very limited. And until we don't get like a much more mature market where you have more dynamism in terms of M&A and secondary transactions, it's going to be very tough just to put a lot of small tickets in companies. I mean, there are some models that are working, but there's still a lot of room to innovate in terms of financial mechanisms.
Thank you, Rodrigo, for underlining that. And lastly, Hamdiya, what about your journey in terms of supporting the ecosystem and deploying financial resources benefiting early stage impact funds?
Thank you, Elena. And as the previous speakers had said, the last 10 years, I say that we have evolved, but that's not to say that we have arrived. You know, we are still midway. And so to just quickly point out that access to early stage funding and the technical support required to assist early stage companies to scale is still lacking, and which means there are greater needs out there that needs to be met. And as Rodrigo said, it means that we need to begin to think innovatively in terms of how we deploy capital. We invest in funds, and what we've seen is that first-time fund managers struggle a lot, and sometimes they tend to raise smaller funds where the fund economics doesn't work. And so how do we get to support first-time fund managers, early-stage fund managers to be able to really deploy the capital? What I have also seen in the market is that after they are able to run their first fund, they are building track record, they are able to raise more funds. And when they raise more funds, ticket sizes goes up. So smaller companies still don't benefit, right? And that's just how the market is growing. And I think that as investors, we need to begin to look at how do we incentivize teams to be able to retain the sizes that, you know, they can manage and invest in smaller ticket sizes. In our part of the world, in Africa, we are still growing the angel investing ecosystem. It's not solid yet, but we are working on it, so that if you have an angel investing system working, then you know that maybe the very seed stage, somebody could put in a lot of money. But we need to build more accelerator funds, and we need to build more very early stage teams who can invest in these companies, and then we scale it. So I call it looking at the whole value chain of investing. We are building an ecosystem. 10 years ago, we didn't really have a very, I must say that it was basically not in too much in existence, the VC ecosystem. 10 years now, fast forward, we have the ecosystem. It is still developing. I wouldn't say it's developed, but then what it means is that there is so much to do. We need to learn more innovative ways of, you know, managing the teams and keeping the teams together and incentivizing them to be able to still do small scale investing. It's a challenge, you know. The moment the fund manager gains track record, he's going to raise a bigger fund. And the larger the fund, the larger the ticket sizes. So we really have to look at that aspect of it. But yeah, I will leave it here and continue.
Very interesting. Thank you, Hamdiya. And for a very fast following round of questions. I like to slightly make a different question to each of you because of what you have said. Susana, you mentioned that you have seen in the market a sort of a cross-fertilization and new players joining the scene, venture, traditional mainstream VC funds joining this the impact space. So how this is going to affect your funding criteria when you look at new fund managers?
Well, I have to say that Capria and the IDB at the time invested in Adobe, in Rodrigo's fund. But as we are seeing this convergence, we are seeing what we call migrant fund managers. They don't have maybe the intentionality that we saw, and we were so happy with Adobe, but they have invested. They have seen that the sectors they invest in, like edtech, fintech, medical devices, wellness, are important and beginning to have impact. And they need to learn. So Capria, part of our huge value add is to move those migrant fund managers to really begin to invest, having and keeping profits in mind, but with an impact intentionality. So the migrant funds is a trend that we support. And because Capri is a network of GPs, they interact with funds like Adobe and they learn from one another. And that will help us mainstream impact and not have it as a niche, because niche can be put aside very easily. But when you mainstream, is important. You can't skip it. So the last thing I want to say in order to keep the tempo going is that also COVID has been a call to sobriety, to invest in the must-have sectors. And what are must-have sectors are those who provide access to basic needs like education, health, finance, water and sanitation, dignified living, solutions for human resources. And what we need is impact investors can do the seed, the growth part, and then the traditional investors are going to come more maybe in the Series B, when we have proven that the market, the addressable market for impact is 1 billion plus. And that is what traditional investors want.
Thank you, Susana. Dondi, talking about this sort of a cross-fertilization that is definitely happening, have you seen some changes in your investment practice, or maybe partnership collaborations with these new players over the last few years?
Yeah, I think definitely that is definitely the observation. Right? I think I can safely say that nowadays, when we look at potential companies in our pipeline, there are potential co-investors that are not strictly impact VCs. They're probably traditional tech VCs, which is very, very different. I think as Susana also mentioned, the adoption of technology in the past 10 years really helped this merging. 10 years ago, it was very early days. Very few people have mobile, for example. So the initial tech investments were mostly in the basics of digital media, e-commerce, and all these things. So the early adopters of those technologies are maybe people like you and I here, right? Then I think it's become so mainstream right now that everyone is on their mobile. Everyone don't mind transacting on their mobile. So that the segment of stakeholders that we're looking at, which are basically the mass market and the micro SMEs, they are starting to use those tools as well. So I think that's really true. A lot of the companies that we're looking at right now, mainstream VCs are also interested when they talk about, for example, fintech. It's no longer the neobanks that cater for the cool millennials and those kind of things, but also the next billion neobank. Yeah.
Thank you, Dondi. And Rodrigo, you have mentioned that you are moving up your ticket size, exactly the fear Hamdiya has for early stage funds. Have you perceived it as a risk for your identity as an early stage fund, or do you think it's really a trend?
Well, I think it's as you all mentioned. I think it's as you scale in terms of growing your fund, and probably your third fund is gonna be bigger than the one we have right now. So eventually you have to move to do bigger tickets. So eventually you have two things. Either you do more, you put more money into the early stage company. It means that you get a higher risk, and you see a lot of that probably more in the U.S. based or Silicon Valley venture capital funds, that they can do like $50 million investments in a startup. So we haven't seen that still in Latin America, but I think eventually we're gonna get there, where you can have bigger funds with bigger tickets for early stage ventures. I don't know if we have the deep in terms of new technology or the mass where we can have a Mexican company becoming the new Zoom or the new Facebook. So we need to think if we are going to have that in terms to get those bigger tickets. But further than that, I think we believe. I mean, we have the private equity fund is doing these equity or early growth funds, but we have the other vehicle that is doing early stage. So they have different approaches. I think that when I spoke about Biwala, that we're doing smaller tickets, we're using a lot of technology. So pretty much we can deploy the money after 70 hours when the company registers online. So it's completely different.
I think it's a fantastic this innovation that you are really introducing in the market. And Hamdiya, really for the last question, have you seen you as well this cross-fertilization in the market between traditional VC funds and early stage impact funds?
Not yet, not yet. I'm sure we will get there, but yes, some of the fund managers co-invest. If it's something that they really want to do, they do co-invest, but it has to be something that both of them are intentional about and they want to do together. I think that in terms of trying to see this cross-fertilization, it will take a bit of time, and it will take the intentionality bit that Rodrigo and Susan talk about, that if the traditional VC begins to be intentional about some of these investments, then we would see more of these cross-fertilization coming. But where that level of intentionality is not there, we will still have some difficulty. But it's evolving. We haven't gotten there yet, but I'm sure that we will get there.
Thank you, Hamdiya. And now I really like to open the floor to, because I've seen some questions coming. And of course, our participants can also activate their microphone, but I suggest each of you, so starting from Hamdiya this time, to pick up a question in the list of our Q&A box, because I've seen specifically one coming for you and Rodrigo. And if you can make a very, very short reply.
Okay, so I see a question on what are some of the incentives to incentivize managers to stay small. I think the fund economics just doesn't work, right? If the fund size is small and they had to invest in early stage companies and take these small ticket sizes, you need to have a certain number of team to be able to really work on these companies, because small companies need work. So I think that some of the incentives to do is to see if you can probably do a little bit of investment in the GP and ensure that at least their working capital side is taken care of to be able to motivate the team to stay. The other thing that we can do to support is the technical assistant, right? So the portfolio companies, we can provide some technical assistance to the portfolio companies so that you allow the team to really focus on the investment, the portfolio management. But then when it comes to building capacity, you know, within the portfolio companies, there is a technical assistance support for the portfolio companies. That way you are able to get the fund management team to be able to still stay and focus on very early stage investing. I think I'll just leave it there.
Thank you, Hamdiya. And Rodrigo, can you pick a question coming for you specifically?
Sure. There's one question say, is your revenue-based financing a variable percentage of realized profits? And if so, what security do you look for? Okay, so very quick. So we do both revenue-based lending. We do through our private equity fund, and we do also through Iguala, which is this non-banking financial institute. And we both, in both of them, we take a percentage of the revenues that are realized. So eventually we have a delay of 2 months, so they can, because sometimes in Mexico, between when you do set the invoice until you get the payment, it could take 2 or 3 months sometimes. So yeah, we do realize profits. And the security, for example, in Adobe Capital, the private equity fund, or securities that we can convert to equity, the balance. In the non-banking financial institution, which is very small tickets, usually we have like a real warranty, and if it's very small, we don't have, it's just a geographic loan, so we don't have any guarantee.
Thank you, Rodrigo. Dondi, can you pick up a question as well? I know some questions are coming on financial returns expectation, and also I think expectation on financial returns from your investors.
Right. Yeah. Yeah. I think I'm gonna mix that about the financial returns, and also there's a question in the Q&A about how to balance impact enterprises that might require more time to achieve financial sustainability.
Yeah,
so in Patamar, we decided to keep our fund product as plain vanilla as possible. Because it's hard enough to raise with the Southeast Asian story, with the impact story, you know, it's hard enough to raise as it is. So we decided to keep our structure to be the plain vanilla, 10 years plus 220 management fee and carry and so on. But I have actually seen some funds, so namely the Asian Development Bank, ADB, actually just set up a fund that is very long term. I think it was 15 years fund. So I can see that they will be able to be more patient, quote unquote, in terms of their equity investment and getting to exit. Also in terms of the returns, as Elena mentioned, we are still looking for us. We are still looking at a risk adjusted commercial return. So it's pretty much close to a commercial return, which would be mid-teens in IRR. But I have also seen, depending on the LPs that you have, I think I've also seen some funds that are more patient and perhaps are willing to take lower returns. Yeah, but we just decided to keep it simple for now.
Thank you, Dondi. And Susana, last question for you coming from participants. Which one do you want to take? Just 1 minute, because I like to close with some remarks from all of you. You have your microphone. You needed to activate your microphone.
A question about changing traditional investors to a more impact or awareness mindset. I think it will be very important in the years to come when the portfolio of the impact funds will show that we have invested in sectors that had a very huge addressable market, scalable markets, and therefore the Series B and C were filled by traditional VCs. I think traditional investors are looking for bigger markets, and impact has a huge market. So I would say that. And then just one other question I saw very short, my answer is I've also seen more venture debt coming into Singapore, into LATAM, that before you didn't have any venture debt funds. And I think it's a good compliment not to dilute the entrepreneurs who want to stay with the significant stake of their companies.
Thank you. I want just to encourage all participants with their fantastic question to get connected with our panelists in the days to come. But I'd like to close our session with a call for action from each of you. Just keep in one sentence or like a recommendation or remark you want to leave to all our participants. Susana, you first.
Okay, my call to action for public and private actors in this space is that you cannot ignore half the population, include women in the equation, make a more diverse industry, not only from the gender point of view, but also include different geographies, people from different backgrounds and incomes.
Thank you. Dondi?
Yeah, my call to action would be for anyone here. I think everyone is all around the world. Wherever your market is, you can always start small. That was our biggest learning. It was a lot of questions in the beginning. How do you find investors? How do you find potential companies? But once you start, once you actually dive in, you get to figure out what you want to do and what you can do. Fantastic
recommendation. Rodrigo?
Well, so don't be afraid or don't be scared to innovate. I think the impact investment sector is going to bring a lot of the financial innovation, and I think we're gonna move to traditional investors. They're gonna copy our systems because I think we are here to innovate. I don't think we need to copy the traditional old models to find ways to invest in this company. So don't be afraid. We are learning, and there's a lot of room to innovate.
Thank you. Hamdiya.
I would say to investors that invest in diverse teams is very important. And to traditional VC investors, I would say just be intentional. Add a little bit of intentionality to it, and we'll get there. Thank you.
Thank you. I think we have said so much. You have added so many reflection and thoughts, and I really hope that we will be able to keep in touch, and the panelists will be very active, I think, to catch up with you the next hours and the next coming days. I really clap to all of you. Thank you very much for your insights again, and enjoy the rest of the conference. Thank you.
Thank you.
Thank you. Bye, everyone.
Thank you. Bye-bye.
Thank you.